Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Call for Monday, December 15th, 2014. Before I hand it over to Keith here this morning, I'll briefly touch on our asset allocation changes from Friday. We reduced our cash position to 61% from 63%. Fixed income exposure was held flat at 32%. U.S. equity exposure taken up to 2% from 0% Friday. Commodity and international equity exposure held flat at 0%. With that, take it away, Keith.
2%. Did you hear that? Net 2% long U.S. equities. Again, we look at asset allocation on a net basis here. Again, I roll the way that I roll, which is not this way. It's the way that we roll, which is, again, like I ran my hedge fund, which is on a net position basis. So again, I'm either net long, net neutral, or in a very long way, long of the long bond currently, which you can still see in the asset allocation. So again, on a big pullback to the S&P 500's trend line of support, which we're currently at 2002, it hit it right on, literally right on the line. We took up some U.S. equity exposure a little bit so that we could sell into strength. So that's that. Today's top three things in my notebook. Number one is Japan. Number two is the 10-year bond yield. And number three is U.S. equity market and U.S. bond market, don't forget, which is bigger than the equity market, sentiment. So first, let's just hit on Japan. They had a big election overnight, and of course, Abe, not surprisingly, won. But again, surprisingly, the Nikkei reacted negatively to that. So again, the Nikkei down 1.6% overnight on the news. And again, this is most typically what you see in stocks or any kind of a story where people are expecting a certain thing to happen. They sell on the news. So again, I wouldn't get, short Japan on that. There might actually be a trading opportunity on the long side of Japan in the face of that, but I'd much rather buy the Japanese stock market closer to 16,500 or less. Second thing that I'd be looking at this morning is the 10-year bond yield in the U.S. Don't forget that it crashed last week. It had been crashing throughout the year, as you know. Being long both growth and inflation slowing in long bond terms was absolutely wonderful. Again, 2.08% is where they capitulated on the close on Friday. And again, if you look at where we are this morning, you get, like a lot of things, a bounce, but the bounce is really not that meaningful. So whether it's oil bouncing this morning by a little bit or bond yields bouncing by 4 basis points, all it's really doing here is bouncing within its risk range. So again, the immediate term risk range for the 10-year bond yield is currently 2.08%, which was last week's closing low, to 2.22% into the Fed meeting, which, by the way, if they do remove considerable time, which they could, again, you could get to buy more bonds on the pullback. I would love another opportunity to buy more bonds on the pullback, whether it's the Fed expectations or Mr. Tepper. Please give us an opportunity. And then finally, sentiment. You're going to need to give some people an opportunity here because sentiment, by measurement of the CFTC futures and options contract data, now again, that might be a mouthful, but that's where hedge funds are positioned. So we look at non-commercial positions. This morning you're seeing, again, S&P 500 has over 48,000 net long contracts as a position, massively long net long position in S&P 500. Again, that was into the swoon last week, so they had that wrong. And as importantly, the net short position in the 10-year Treasury. Get this, net short position, 214,778 contracts to the net short side. Again, that was one of the worst calls of the year. And again, if I look at my super secret outlook for 2015, did I just show that? That just bans me from Barron's for the rest of the eternity. But the reality is that those experts in Barron's who are looking for interest rates to rise last year, or I should say this year, are looking for them to rise again next year. Well, isn't that fantastic? Those are your top three things. Today's morning show. Okay, so again, I got to get through the whole thing here. Risk ranges, levels, views, my ranting, etc. S&P 500's current risk range is now widening. Okay, widening. 1980 is support. 2038 is resistance. So you have more upside than downside for today. You have 1.1% downside versus 1.8% on the ups, and that's why we got a little longer into Friday's close. Covered some shorts. We have more longs than shorts in real-time alerts. You can see that 7 longs, 4 shorts, and you can see that we have a wider net long position by a little bit in U.S. equities. Again, you don't just be bearish at every single price. That's just dumb. Looking at the risk range in the Russell 2000, don't forget that the Russell was down another 2.5% last week. If you look at the Russell, really for the last 7 weeks, you'll note something, even if you're only a chartist. You will say, wow, the chart has done absolutely nothing and only gone down. So again, it's down for the year to date. If you're still telling yourself on December the 15th that a broad measurement of the U.S. stock market, which is the Russell 2000, is down and that's a bull market, I mean, come on, man. I mean, that's at this point, that looks worse than Johnny Manziel. Okay, and that's pretty bad. Okay, looking at the VIX, the risk range 2108 is where we closed last week. The VIX was up 78% last week. No worries, no worries, no worries. You know, all the interconnectedness that we've been talking about came slowly and then all at once in terms of a risk. But again, if you were long bonds, there was really no volatility at all. So again, think about returns the way that normal people that invest money with other people, think about returns. They think about the volatility of those returns. Don't forget, they think about the absolute return of the return, and then they think about the volatility of the return. So not only is the return of the long bond, whether it's the TLT or something like EDV up 24 to 40% for the year to date, monstrous relative to the Russell, which is down for the year to date, but there's no volatility in that return. So again, it's just been a fantastic year to learn. If you didn't learn, we hope that you can start to learn. Again, there's a lot of things to learn of volatility adjusted returns and being long bonds or being long stocks that look like bonds. Utilities, by the way, last week were actually up on the week. So again, XLU being utilities, not up a lot, but not down a lot is the broader point. XLU was up 0.1% on the week. Hooray. But again, if you're long utilities instead of long energy, which was down over it was down 7.8% last week for the XLE. That was a heck of a nice position from a long short perspective. Looking at Asia last night, as I pointed out, Japan down 1.6%. Interesting only because it's in the middle of its risk range. So what we would say about Japan is that it's bearish from an immediate term trade perspective, but it's bullish from an intermediate term trend perspective. So again, let me say that again. Bearish trade, bullish trend. So again, immediate term bearish, it broke its trade line. Intermediate term bullish. That means you have to maintain two opposite thoughts at the same time in your head and remain sober. Again, it's Monday morning. You should be sober. So again, think about this. You are going to be, if you listen to us, God forbid, multi-duration, multi-factor. That's how we think about it. Multiple things in our heads all at the same times. So maybe even a hockey player can kind of get it right once in a while, even while he does that. Hong Kong down a full percent last night. Thailand down 3.1% last night. Indonesia down 1% last night. If you close your eyes and you say, what happened in the rest of the world? Well, the rest of the world went down a lot last week. And again, the message is that unless you have a gigantic, enormous, really fruitful and bountiful central plan, your market's going to go down. I'm sorry about that, but that's what happened last week. Last week, Latin American securities were down 6%. On the week, they're down 16% for the year to date. So if you're long those, that's not good. Russia was down 12 on the week. Greece was only down 20% on the week. I mean, there's some pretty big headaches out there. If you're long MLPs, they were down 6.5% on the week. And you got some dudes just kind of like floating around saying, but dude, the Dow is fine. The Dow wasn't fine last week, by the way. It was down 3.8%. But it was more fine, I guess, than that stuff. So again, look at Asia more broadly. We've been seeing this really for the last 6 weeks. You've seen Asia, ex-Japan and China, has been very weak on both a relative and absolute basis. Very important risk management point. Now, looking at Europe, you've also seen the disconnect between the FTSE and the DAX. So in other words, the FTSE has been down and the DAX has been relatively strong. That's because the FTSE has more energy components. But again, the FTSE is a very important, much like the Kospi in South Korea, a very important macro barometer of both growth and inflation expectations. Those continue to fall. So watch the bounce this morning in Europe. You're getting what I'd call kind of like a Chicken Little bounce. It's not really doing a whole heck of a lot to stimulate me personally, although I am very difficult to stimulate in European terms. Okay, so again, think about that. And again, don't think of the French side of things. Don't think about whatever that you might be thinking about when I said that. Just think about it in terms of what the bounce looks like. The biggest part of the bounce this morning is in Greece. It's in Greece. Greece was down 20% last week. It was down 13% in a day. Do you think it's going to bounce? I mean, obviously it's going to bounce, but Russia didn't even bounce. I mean, Russia, the ruble obviously is collapsing here. I heard my friend Tom Keene say on the radio on the way in, it's fascinating. I mean, fascinating? Why is it fascinating? I mean, this has been happening for a long, long time. You should not be fascinated with the concept that Russia, rubles, and oil are all interconnected and going down in kind. That should not fascinate you. That should not be surprising to you. That you should not be long rubles because they look cheap. You should just say what I just said and enjoy it. Russian stock market down 43% for the year to date, inclusive of this morning's decline. Just to round off the edges here on oil, if you're looking for a risk range, on the immediate term, risk range for oil currently 56.48 is support and 63.21 is resistance. So again, much like bond yields, which look identical, by the way, to oil currently. They're both crashing. They're making lower highs and lower lows within the risk range. Again, I'll say that again. Lower highs and lower lows within bearish trends, again, are bearish, particularly when things are crashing, like oil and bond yields. They're explicit read-throughs to the negative side on demand and growth, and I suggest you respect it. Copper, looking at the risk range there, because again, you want to be shorting copper on bounces. 296 is the top end of the risk range with no support to 2.83. On bonds and foreign currencies, I already said my piece. Actually, if you're looking for the risk range on the yen, a lot of people trading the yen, the current risk range is 117-ish to like 121-ish. And again, we'll just go with the ish on that. And away from that, economic data points before I get into some questions here. You just had more deflation. So Swiss producer prices, which is again producer price inflation, down 1.6% year over year. That's for November versus down 1.1% in October. So again, in spite of or despite what Draghi is doing, they're getting more deflation. So again, the whole concept of the policy to inflate is actually to get things to go up, and they're not going up currently. So that, I do think, is the beginning of the end, which is, again, after everyone's cut to zero. And I highly suggest you watch the Ray Dalio interview from last week, because he's one of the few who's explained this in 3 minutes or less, which is, what does deflation mean? What does it mean for asset price inflation expectations? It's a mouthful, but it matters. Evidently, last week was a big bell ringer for people who did not understand that. So a good spot, I guess, to take some questions away from. I just need to mention this quickly, because of course it's not a bubble in the IPO market. Never was a bubble. Nothing was a bubble. Bubble. But the Survey Monkey, the company, just got a $2 billion valuation. Cool. PetSmart's going to get LBO'd at, I don't know, $8 or $9 billion bucks. Smells a little like 2007 with like parts of my 2000 holiday season all wrapped in one, just like bubbly.
Same kind of thing happens over and over.
In different ways.
Yeah, I hear you. All right, we got a question on TLT. I think someone's getting a little bored of the position here. How much more does TLT really have left to rally? Wouldn't short it, but what gets you excited about it right now?
If you can't tell how excited I am about being long bonds, and rewind the last 10 minutes of my rant. I mean, it's pretty straightforward. Look, we're going to get this question now because people who didn't buy the long bond, people who didn't buy it are going to say, okay, nice call, but I can't buy it up here. Same person saying, hey, nice short call on Russia, the ruble, and oil, but I can't short it down here. Well, what are you going to do? You going to go short the long bond? I mean, if that's the question, the answer is absolutely no. What I'd be looking for is opportunities in the long bond to do more of what we've been saying to do, which is be with the best position that I can find you in global macro. And again, I do think about the best position on a volatility and risk-adjusted basis. So again, if I get tepper, if I get considerable time removed, if I get some, I don't know, whoever, if I get more of these guys, I don't know if you can see these guys. These guys, these guys are not this guy. These guys, this is Barron's, by the way. This is Barron's, the forecasters. I can read, much like, actually I have it from last year too. These guys, this is sideways. So it's these guys and these guys. They're the same. Actually, there's new guys on this one. There's new guys. There's some guy named Dubravko. I don't know who these guys are, but they're really wrong. Like if you look at the 10-year risk range that they have, 10-year yield target for 2015, I guess Tobias got like really cute with it and he went to 2.95% as his 10-year target. But generally speaking, from everyone from Dubravko to whoever, it's like 3% 10-year, 3.0. They all have GDP of 3.1, 3.0. Yeah. Sorry, folks, that's the only catalyst for the long bond is until all these people, and you got to use them all, some are the same people, they have to capitulate.
Yeah, I think a couple followers found the Barron's article pretty interesting too.
Sorry for doing that. Some of you I'm friends with, but you got it. I mean, if I look like that, or the money guy yesterday, I'd call myself out too. Come on, guys.
And actually, someone points this out, 67 out of 67 economists on the 13th of December said higher rates in 2014.
Wow.
Yeah. And
that was useful.
Do you find it amusing, and I'm sure that you probably do, the very week Barron said this time it's different, the Dow Jones fell 700 points.
See, this is unequivocally why we're not going to be in Barron's. Because if we call these things out again and again and again, I mean, there's a very high chance that Barron's and Bloomberg Magazine, don't forget on the cover, had a picture of John Maynard Keynes suggesting that this time was different as well. So Keynes wins forever. As anyone who's studied history past, Joey's timeline knows, the reality is that there's a constant battle in economic frameworks and economic strategy between Keynes and Hayek at a bare minimum. Anytime you get too polarized to Hayek's side or too polarized to Keynes' side, it's about to reverse, or at least the process becomes in motion. So you could very well have Barron's have said it's different this time when Bloomberg did, at the same time when it wasn't different this time.
Yeah.
It's like, what else can we say about that?
Yeah, we got a question on oil here. Is this just solid short covering this morning in WTI, or are there new longs being initiated since Sunday's open? And last night, crude actually opened down pretty hard, like almost 2% down. Now it seems like it's regained some ground. I guess it's a good opportunity maybe to talk about the process and how we look at it.
Yeah, I don't have some super secret magic wand. We don't have a dude at OPEC that calls us. We definitely don't do something, that's unbecoming. What we do is literally ask the market. So we ask the market on a price, volume, volatility basis. It's a 3-factor model. Again, we don't use a single factor chasing momentum moving monkey thing. Again, we use those 3 factors to tell us on a forward-looking basis. Again, it's more of like a Bayesian process than anything else. Bayesian process being you take the most recent input and you change your forward outlook. So again, I'm in the business of not being wrong. I am going to be wrong a lot, but I don't want to be wrong like these things. So again, you look at the oil price, and again, we update it every 90 minutes on price, volume, and volatility factors. And what you're seeing currently is a series of lower lows and lower highs within a crash. That is clean cut, stay away until you see some stabilization. And I define stabilization on a price, volume, volatility basis. So again, think about those 3 things, adopt them into your process, or at least evolve your process and think about them in terms of what's actually happening. Is volatility rising or falling on the margins? And is that going to create a volatility situation that's going through a phase transition? So again, oil, obviously, it's a very highly volatile phase currently. We would have to see something go less volatile, and we cannot find that in the current data, which is why I think oil whips around like it does from an hour-to-hour basis.
Great, thanks. A lot of questions on Japan. I'm going to try to find one that you haven't already answered, that you didn't already answer. These questions came in beforehand, but is DXJ, let's see, actually I must have, yeah, here we go. How about the Nikkei? Is a hedged ETF like DXJ a good option going forward? Does that ETF work? I mean, does it track?
Yeah, that's the one that we chose, the DXJ,
Right.
the Wisdom Tree Japan hedged equity. We actually shorted that appropriately at the highs, I guess a week and a half ago. And again, we'd use that. I don't love every ETF. There's an ETF bubble, to be clear, and that's going to upset some people. But newsflash, I think everybody who's alive and cooking here this morning understands that. But there are certain ETFs that fit my parameters. Not the double up, double downs, not the reverses, but the DXJ I can deal with. So again, I deal with it like any other security that ticks: price, volume, volatility. If it ticks and it doesn't have some kind of violent or I guess unmodelable, which take for example something like the VXX. I can't model it. I mean, I can't get it right, so I don't use it. But DXJ we do. I think it's a good one to use on both the long side and the short side of your Japanese equity view.
Okay. And then with regards to the VIX, can you talk about volatility across asset classes right now and the VIX ranges, which you've already hit on the VIX range?
I mean, the VIX risk range was yelling to you before, by the way, before the waterfall, that it was a waterfall. Again, we talk about, for those of you who don't know what I'm talking about when I say the waterfall, you can either just try it yourself in West Virginia, or you can just try it at home and look at markets from a waterfall or a point of entropy perspective. So again, the body of water, if you're analyzing it past your nose, so what you can see below the surface, you will see that volatility was in a bullish phase transition. So again, bullish phase transition, we made this call on July the 7th. We called it volatility's asymmetry. So again, that was setting up for big and more volatile moves in volatility from that point. And again, because the waterfall, we could see it approaching in terms of interconnected factors of risk in the marketplace. And again, even if that sounds like a mouthful, I could say it very slowly and it'll still make sense. There are multiple factors in the marketplace that are observable by people who have a process. And again, when you look at volatility currently, the big spike in volatility between September and October and the big spike in volatility between really the end of November and now should not be surprises to anybody who uses a Hedgeye process. So volatility is in a bullish phase transition. So volatility, at a bare minimum, you want to be long. Again, you want to be long it before the volatility explodes 78% to the upside like the VIX did last week. But again, last week's move is only confirming the Hedgeye view, which is this is not the new normal. This is called a phase transition to a higher level of volatility. And again, there's a lot to do with that, not the least of which is not buy high trying to sell higher and U.S. equity momentum landed every single time that somebody asks you to do it.
Okay, last question here.
By the way, the risk range now for the VIX is wacky wide. I think that was part of the question. It's 15.5 to 22.5 or 22.71. I mean, that's a really wide range. And again, when ranges widen, that is a sign of more volatility to come, not less.
Okay, and then last question here on the leverage on producers' balance sheets, oil energy producers. Will the large amount of oil debt outstanding cause a run on something else like peripheral bonds as margin calls come in?
Sure. I mean, if you're long, maybe not peripheral bonds, but just think of a couple things when you think of contagion in an asset class. So again, contagion in high yield and junk. If you can't see it, then look at it again. And again, when you start to see that correlate, people say, wow, do I want to be long illiquid bonds that are risky? Now, maybe that does peripheral bonds, maybe it does actually fit the profile. So if you think of Greek bonds or something else that hedge funds are long, I mean, they can't get out of them, I can tell you that. And point number two on that, away from liquidity and not being able to get out, is that they're not marked to market. They're not marked to market. So again, when assets aren't yet marked fully to market, and or you can't show a significant amount of bonds on the offer, and I suggest if you own Lynn Energy bonds, you try that. Why don't you put a couple $100 million of those babies on the offer, and then we'll see the real price of Lynn Energy bonds. So again, go to any distress asset. This is called distress for a reason. They're called junk for a reason. There's interconnected risks associated with deflation to junk and the high yield market, and no, it doesn't just stop at energy. It stops at anything that has a policy to inflate expectation as far as the eye can see. And again, I highly suggest that you do more reading and or listening on that because, again, we're in the early stages of that phase transition, I think, as well.
All right. Thanks, Keith. Thanks for dialing in, everyone. Thanks for tuning in, and we will catch you back here tomorrow, same time. Good luck out there today.